Hi everybody, my name is Nivesh. I'm currently doing my PG DAS at University of Pretoria, and today we'll be discussing inventory recognition and measurements, emphasis on purchasing inventory as per the IAS 2 standard in IFRS. Okay, so as we all know, inventory is an asset that is bought or manufactured with the intention to resell at a profit. So normally companies would buy inventory on a regular basis and store it for a short period of time. And sometimes, most of the times, we plan on selling it within 12 months. Hence, we classify it as a current asset, as current assets are assets that can be converted into cash within 12 months. And if we sell inventory, we will get cash, eh, um, in essence, unless we buy on credit. I mean, if we sell on credit, then it would be a trade debtor. But also, trade debtors are also classified as current assets, as we expect the debtors to pay us within 12 months. And as such, current assets are presented under current assets column in the statement of financial position. And since the question which was given asks about the purchasing of inventory, the focus of this video will be on the purchasing and rather than the manufacturing of inventory. Okay, so the types of inventory systems, there are two main types used in business and commerce. The first one is the perpetual inventory system. It is commonly used by businesses as well as in academic studies, mainly because you are able to continually update your records with inventory transactions as and when they occur, and thus you can keep a record of your cost of sales because every time you buy something or sell something you record it. It's unlike the periodic system where essentially you only determine cost of sales at the end of the year or end of a specific month depending on the company's um, policies, by means of a stock count where people will literally count the stock you have to see what they purchased, what they sold, etc. And in that same breath, this also means that the net realizable value (NRV), as well as abnormal transactions and losses, are absorbed automatically into the periodic system. And this is different from the perpetual, where we would have to like discuss it separately. And this will be discussed later on in the video, so do not worry. Okay, so this is just a small example of the perpetual and periodic system. So if you look at the second picture right next to the word example, you will see the perpetual system. There are two T accounts or general ledgers, inventories and cost of sales. So normally the inventory account is where we would say our opening balance and what we sold, as well as our closing balance. So you can see there's two cost of sales journal entries, I mean entries on the left side of the inventory T account. One would be for NRV, which I will discuss later, and the other one is for when you sell something, because logically when I sell inventory, I will have less inventory, so I would have to remove it from my inventory balance. Hence, that's entry. And remember, in T account, there's always a contra account. So if we sell inventory, we incur cost of sales because we bought the inventory to sell it. Buying the inventory was a cost, and now we sell it, so cost of sales. All right. And then you see the second T account, cost of sales. There's an inventory entry that will be corresponding with the entry you put in inventories. Yeah, and that's basically it for perpetual. Like you keep on doing that every single month or every single year, dependent on accounting policies. Just remember, inventory is an asset which increases on the debit side and decreases on the credit side, and cost of sales is an expense which also increases on the debit side but decreases on the credit side. Okay. And now the periodic system, the second one, there are actually four columns, I mean, four T accounts. The first one is inventories. You can notice here that I use the words opening inventory and closing inventory instead of using the word cost of sales because we only calculate that fourth T account, the cost of sales column, at the end of the year. So we use opening inventory and closing inventory to help calculate the cost of sales. Your opening inventory is normally we normally we transfer the balance to cost of sales at the end of the year, which is evident from the picture. And purchases is whatever you buy. I mean, purchases is an expense. So if you buy it, increase on the debit side and decrease on the credit side. So we transfer to the cost of sales. We have to remove it from the T account for purchases. And that brings us to the most important column, T account, the cost of sales account. Literally, as I said earlier, the account formula opening stock plus purchases minus closing stock equals cost of sales, which is evident from this T account. Remember, cost of sales increases on the debit side and decreases on the credit side. And we transfer that amount, balancing amount, to a trading account, which essentially ends up in this blocky. And that's basically how we account for perpetual and periodic systems. Okay, so inventory measurement methods. So there's three methods used by businesses, of which the most common is the weighted average and FIFO. So I'll start with the FIFO. So essentially, we buy stock at different prices, probably throughout the year, um, and prices change because of inflation or other circumstances. So FIFO tells us that when we sell inventory, we must always start with the inventory that is the oldest, meaning the ones we bought first, and recognize the cost at that specific price. You know, so that's why we do that, and we keep on doing that until we finish all the inventory in our balance, meaning that we start with the oldest and move upwards to the newest. Don't start with the newest; you always start with the oldest. It can be quite tedious, especially when there's lots of inventory purchased, hence why many businesses use automated processes. Also, the weighted average method, basically, instead of using a specific price at which a good was purchased or inventory, we take the total purchase price divided by the number of units we purchased. And this is done on a continuous basis because we basically buy inventory regularly. So the weighted average is much more simplistic and works just as well. Okay, specific identification is similar to FIFO. The only difference is that the cost price that specific item has is used, but it's different from FIFO in the sense that we don't have to start with the old. We can use whatever stock we want as long as we use the price that we bought it at. And don't confuse this with the system. The system just explains how we account for the inventory. This methods explain how we measure the inventory. There's a difference. And normally, this will be given in a scenario or test, which method the company uses. Okay, measurement of cost. So IS2 states that all costs necessary to bring inventory to its present condition should be capitalized costs. So think of it this way: once inventory is ready to be sold, we can't capitalize any more costs. So we would rather expense those costs instead of capitalizing. So examples of costs that we would, for example, capitalize would be import costs if we buy from or if we export or import. Further processing costs, for example, a coconut that we sell coconut water. So we have to first clean the coconut, crack it, and get the water, and process the water. Those costs should be capitalized as it is in the process of making our inventory. If we are in a manufacturing company, insurance only if it is to insure inventory that is going to be transferred, that's still in production. Basically, what that means that is that if we are, for example, transferring finished goods to a retailer, um, that amount of insurance would not be capitalized because the finished goods are finished. As I said earlier, it's ready for sale, so we have to expense that insurance. But if it's for raw materials we transfer to a manufacturer, we'll capitalize it as the inventory is not ready for its present condition. So always refer to your standard. The IS2 standard is always a good idea to flag and have on hand as it helps you understand. And yeah, it saves you in case you forget something. All these costs that I'm mentioning are in the standard. Discounts are not part of costs. It just affects the amount we pay, but it does not affect the actual cost of the inventory. So yes, that's measurement of cost. Now, as mentioned earlier, the NRV, IAS 2 states that inventory shall be measured at the lower of cost and net realizable value. So if the NRV is lower than cost, it means we have an additional cost because we recognize an asset at a cost that was higher, or value that is higher, but in reality it was actually lower. So it means we didn't account for an expense or something while measuring this asset, or circumstances change, like for example COVID. Um, for example, cars. Maybe the price of cars went down because less people were buying. So we had an NRV that was lower than cost. So we had a write down, which normally goes to cost of sales, or a write down to NRV, which is basically an expense. But you have a choice. Like if you want to put it in cost of sales, by all means, it doesn't affect the overall answer. And you may be wondering, how do you calculate NRV? So basically, it's the expected selling price minus further processing costs. Expected selling price means the selling price we expect people to buy at in future. And further processing costs is costs we need to incur before we can make that sale. For example, selling costs or repairs to that asset, examples, etc. And this test is only done to the closing balance of inventory, as that's the only inventory still on hand at the end of the year. Okay, so as mentioned in the question, you wanted to know what accounts are impacted by the purchase or sale of inventory. So we are using the perpetual system here as it makes more sense to explain, but the periodic is exactly the same. There's no changes, except there's no actual changes except for when you sell. But I'll talk about that just now. So the purchase of inventory is the same for perpetual and periodic. Basically, I debit inventory and credit bank or creditors. The reason I debit inventory is because I bought inventory, which means I have more inventory in my balance. So I increase it, and an asset increases on the debit side. Okay, it's a good idea to put the components also. Like for example, SFP is statement of financial position, SPL is what I use for Sploky, etc. OCI, statement of changes in equity. It all depends on what the scenario asks you. And then I will also say credit bank or creditors. Credit bank if I pay for the inventory in cash because I have less cash in my bank account. A bank is an asset, so I credit it to reduce it. Or creditors if I buy on credit because I haven't paid the creditors yet. But creditors, remember, is a current liability. We expect to pay them in 12 months, within 12 months. And if we don't pay them within 12 months, we have to discount the amount paid to a present value, which basically means you take the total amount you paid as a future value. N would be 1, I would be a pre-tax rate to get a present value, which is more of a third year transaction, which will be dealt in third year. Right. That's basically the purchase. Simple as that. And then the sale of inventory, there's basically two different entries. The first one is to account for the sales. So I would debit bank or debtor and credit sales. So credit sales with the selling price that you sold the inventory at, and debit bank with the amount you received, which is normally the selling price if it's received in cash, or if you sell to a person on credit, a debtor, you would debit debtor. And then that accounts for the sale. But remember, I also sold an asset I had. So I would say debit cost of sales and credit inventory. The reason I credit inventory is because I sold a current asset I had. So I need to reduce my balance and assets reduce on the credit side. Okay. And remember, I bought the inventory, which was a cost to me with the intention to sell it. So when I actually sell that asset, I'm basically incurring a cost to make that sale. Hence the term cost of sales. That's why we debit it, and cost of sales is an expense. So that's basically the accounts impacted, the measurement, the recognition, NRV, and basically how we account for purchases of inventory.